Good evening, sir.
Good evening. I'm just trying to share YouTube with others that will not be able to access the Google Meet. Okay. Once I'm done with that, we will start the class. Are you with me?
Yes, sir, we're with you.
Yes, I'll be able to share with them. So
Yes.
So the question I intend us to use is the one I shared earlier. Hold on. I want to share my screen. Let me share. Okay. Okay.
Good evening, sir. Yeah, welcome, sir.
No problem. So once you are able to see my screen, let me know so we can start.
I can see.
Okay.
I can see your screen, sir.
All right. So good evening, everyone. So
Good evening, sir.
I'm so sorry we have to take this down before the class will commence. We actually start off very, very early. I don't know why we have to stay delayed till this time. But we thank God we are back together now. So without further delay, let's go to it. So the standard we are treating tonight is IFRS 5, which is non-current asset held for sale and discontinued operations. Now, there are certain things, because of time, I will not be doing line by line explanation or reading on the theoretical part because I really still want us to tweet the questions. I shared it on all the groups already. So when I'm done with this theoretical part, we move on to solving whichever one we are able to solve because of time. So, but I think I would deliberately want to start with a question that I want to see whether you've understood what IFRS 5 is saying before I even do some other ones. I want to test your understanding with that. But let's start off. So when it comes to IFRS 5, as we have heard, it's all about asset held for sale, meaning that it's a group of your assets or when a parent body, you know, in consolidation, you have the parent, you have the subsidiaries. So when a parent body has decided to sell a part of its subsidiary, that's what we call discontinued operations. It may not be that in that line too. It may be you have branches across several places, and you deciding that okay, this particular branch is no longer serving the interests of the company, it's no longer effective, it's no longer efficient and effective, or either way. So there is need to pull it off. So that's what this standard is all about. And how do we look into presenting it? How do we look at measuring it and all of that? So those are the things we need to look at as far as the standard is concerned. So let's go right into it. Like I said, I'll be somehow very fast with, I'll just pick on the necessary part of it that I want to talk about. Okay, I deliberately want to read this. Yes. International Financial Reporting Standard 5, non-current assets held for sale and discontinued operations, is set out in paragraph 1 to 45 and appendices A to C. All the paragraphs have equal authority. Paragraph in both. Okay. This is not what I'm looking for. Sorry. Okay. So yes, I will need to dwell on the objective and the scope before I start paraphrasing others. These are very, very important. These are the things you need to really understand when you are dealing with IFRS 5. So the objective of this IFRS is to specify the accounting for assets held for sale and the presentation and disclosure of discontinued operations. In particular, the IFRS requires two things. Please, you don't need to calm it, just understand. The asset that meet the criteria to be classified as held for sale to be measured at the lower of carrying amount and fair value, less cost to sell. Lower of carrying amount. The carrying amount means what? Anybody?
Book value.
The book value.
Thank you. So that's your net
That
book
is
value.
value.
Thank you. So, and your fair value is your IFRS 13, as we discussed last week. Somebody reached out to me. It's unfortunate I've been very busy, seriously. So someone reached out to me on the, I think, question, is in May 2023, I can't remember the question, on IFRS 13. To be clear, in that question, they actually projected three markets, ABC, and they gave some information about those markets and the assets that are meant to be extended in those markets. There is a particular statement that clear out the whole thing, because before you actually go on to fair value your assets, you need information. In fact, information is the basis of your fair value. So if you don't have information, you can't go ahead and fair value, because that is the, in accounting, you just come out from nowhere and just come up with a figure. No, it has to have basis. So that in that question, there is an information that will point you out, that point you to what you need to solve it. They later, after they did all those three markets, they now later provided information about that asset and some factors that affected this, and they provided the basis for calculation, and that is what you just use. So if you check the solution, that's what happened. So in this case too, you actually do your net book value, then you compare it with fair value less cost to sell. I just told you how to go about the fair value. It's not a big thing. It's just about how do you ascertain what the value of that asset is as at the time you want to know that value. And it happens every year for PLC and then other rated companies, those that are actually listed. So I am dwelling on this because it's the basis of everything we want to do when it comes to this particular standard. So, and the position on such assets to cease. Hey, yes, this is very crucial to understand. They are telling you that by the as at the date you determine that you are going to classify this asset as held for sale or a discontinued operation, that day it ceases to be depreciated. Please, very important, very crucial for you to understand. You can underline it, you can do anything, but understand that as at that date you have decided that, oh, this asset is classified as held for sale, you no longer depreciate it. It's very important. If it happens in the first month in the year, throughout that year, you will not depreciate. If it happens in the second month, you only depreciate for first and second month. If it happens in the third month, the same way like that. So please get that clearly. It's very important. Give me a minute. I need to. I was even calling Mr. Kabiru to maybe provide solution on those issues we were having before. So let me just get back to you. I'll give you just 1 minute. Okay, I'm back. So please, that part is very important. Though. Those are the technicalities you need to. Sorry, it's Mr. Kabiru that was calling. Oh yeah, mute your mic. Oh, don't let me start muting your mic. I want us to interact. Okay. Can you hear me?
Yes.
Okay, so moving on. The second objective of this particular standard is that the asset must meet the criteria for it to be classified as held for sale. And when that happens, you don't add it up to all the other assets. It is presented separately. So those are two. It's presented separately in the statement of comprehensive income and also statement of financial position. Why is there a echo like this?
Someone is opening his or mic. Off it.
Suleiman Usman should mute.
Hello?
Hi, we can hear you, sir.
Good. This is better. So please, that objective is very, very crucial. Like I did, as far as I didn't want to waste time on this peripheral, but I need you to pay attention to that. It's very, very important. So let me summarize it again. One is the fact that when it comes to assets held for sale and discontinued operation, you know, I broke it down to you for you what it's all about, and I believe you grab that aspect. So when it comes to them, it has to do with the fact that it must meet the criteria. The criteria we look at it, I will mention them. I'll don't be fast about it. So it's how to measure it is that you measure it as the lower of carrying amounts, which we termed net book value, and the fair value. And I told you what fair value is all about. Fair value is not a stranger, it's about information. You can't value anything without having information about what the price is at that point in time. So we have markets and the grid of those markets. So those are the things we did when we were doing IFRS started. So once you do that, then you now less cost to sell. So all of these are very crucial for you to understand. And I mentioned that in this case too, depreciation will cease as at the time you have decided you want to classify it as held for sale or discontinued operation. You cease depreciating it. That's very important. Then the second part of the objective here states that once you classify it as held for sale, then it's not going to be presented as your normal assets. It will be presented separately. You name it target asset held for sale, or if it is discontinued operation, you name target that. So you know, mix it up with your other assets. This is very important. Now, what's the scope? The scope implies what's the coverage? What are the aspects of your accounting or financial reporting that is affected by this particular standard? That's what scope is. Whenever you hear scope, understand that. So the classification and presentation requirement of this IFRS apply to all recognized non-current assets and to all disposal groups of an entity. The measurement requirement of this IFRS apply to all recognized non-current assets and disposal group, except for those assets listed in paragraph 5. So those exceptions will list them, and you should please write them somewhere when I'm listing them. There are about 7 or thereabout, so that you don't need to come anything at all. I'm begging. You just need to understand. So assets are classified as non-current in accordance with IFRS 1. Presentation of financial statements shall not be classified as current assets until they meet the criteria to be classified as held for sale. In accordance with this, we will treat that as we move forward. The next one. Sometimes an entity disposes of a group of assets, possibly with some directly associated liabilities, together in a single transaction. So a disposal group may be a group of cash generating units, CDUs. This also, I told you that now when I said it could be a branch, it could literally be a set of assets that they cannot be separated. Yes, they have some similarities that bind them together. In fact, if you want to sell them, you have to sell them together. If you want to buy them, you have to buy them together. So that's what cash generating units is all about. Most of the time, I may not really be more explanatory on those ones. So these areas, okay, there are 6. You should pay attention that all of these are excluded from the treatment of IFRS 5, which is Deferred Tax Act, which is IFRS 12. Assets arising from employee benefit, IFRS 19. Financial assets within the scope of IFRS 9. Non-current assets that are accounted for in accordance with the fair value model in IFRS 40, investment property. Non-current assets that are measured as fair value less cost of sale in accordance with IFRS 41, agriculture. Groups of contracts within the scope of IFRS 17, insurance contracts. So all of these are exemptions. IFRS 12, which is your income tax. IFRS 19, employee benefits. IFRS 9, financial instruments. IFRS 40, investment property. And 41, agriculture. So, and the last one is IFRS 17, which is your insurance contract. The classification, presentation, and measurement requirements in this IFRS applicable to a non-current assets or disposal group that is classified as held for sale apply also to a non-current asset or disposal that is classified as held for distribution to owners acting in their capacities as owner, held for distribution to owners. So these are just the further breakdown. Okay, this place, I need to dwell on this, and I need you to please pay attention, please, because once you understand this part I want to discuss, I can go and start looking at those questions and see how long we can dwell with it, how well we can actually handle them. So, but this area is the most crucial part now. This is what will tell you how to go about treatment of your IFRS 5. The first thing, an entity shall classify a non-current asset or disposal group as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continued use. You can read that again. An entity shall classify a non-current asset or disposal group as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continued use. I hope you get that. Secondly, for this to be the case, the asset or disposal group must be available for immediate sale. That is, it must not be that something has to be done before it's in a condition that it could be sold. It must be such that nothing needs to be done. If we see a buyer now, the person can have it. So it's not that we still need to be 3 months, 2 months, even a month. You can see barely a week or 2 days or whatever. That's it's still manageable, but it must be ready for sale. So in its present condition, subject only to terms that are usual and customary for sales of such assets or disposal, and its sales must be highly probable. That is, there will be high probability of it being sold. The next one, for the sale to be highly probable, the appropriate level of management must be committed to a plan to sell the asset. This is, in fact, based on their actions. Let's take for instance now, the management has designated that this asset is held for sale, but it's still part of what counts for the daily operations. No, that must not be. That must not be. There should be clear indication that it has already been taken out and is ready to be sold. So there should be efforts from the management that showcase that yes, they are really trying to sell it. There should be adverts, there should be display, there should be, some sort of things that actually showcase that they really want to sell it. Can anybody hear me?
Yes, sir, we can hear you.
We are hearing you, sir. Yes, we are hearing you.
Okay.
But your screen is
Can
not
you-
moving now. So
We can hear you, sir.
Wait, am I not sharing my screen?
it's delayed.
Yes,
It's delayed.
we are seeing you.
No, I'm
We
not
are,
moving.
we are, we can hear you and we are seeing your screen.
I'm not moving that fast. This area are the areas I want to focus on. I'm not even going to take all these 20 pages, but once I'm done with this explanation of what qualifies an asset to become held for sale, I can move on to the question I want to look at because of time. Yes. So let me read this part again. For the sale to be highly probable, the appropriate level of management must be committed to a plan to sell the assets or disposal group, and an active program to locate a buyer and complete the plan must have been initiated. So this is logical. Nobody needs to tell you that, okay, yes, they have said they want to sell and they have. You need to infer from the story they'll give you in the exam. Okay, from this, we can see that the management is committed to selling the assets. So we see from our examples anyway, from our question. Further, the asset or disposal group must be actively marketed for sale at a price that is reasonable. Not that you know that they said that they will mention it to you. You know that they said that asset or based on the carrying amount or the fair value that you got is meant to be sold for 2.3 million, and you are not pricing it at 5 million. You will not see a buyer. It's not possible. So price that is reasonable in relation to its current fair value. In addition, the sale should be expected to qualify for recognition as a completed sale within 1 year. Yes, there must be a program in place that set out committed to get it off within a year. So because of time, I may need to move on. So when I share the material, you can read up all that. An entity that is committed to a sale plan involving loss of control of its subsidiaries has classified all the assets and liabilities of that subsidiary as held for sale when the criteria set out in paragraph 6 to 8 are met. Regardless of whether the entity will retain a non-controlling interest in its former subsidiary after the sale. I told you this before now, so we can move on. Event of circumstances may extend the period. Yes, this is very important for us to understand. Yes, for one reason or the other, circumstances beyond the management control may compel them to actually hold that asset beyond the year. Yes, if that happens and it's not their own doings, it doesn't put it off that they cannot still recognize it as held for sale. So, sale transactions include exchanges of non-current assets for other non-current assets. Yes, those are the ways we can get it sold too. Look at this. When an entity acquires a non-current asset exclusively with a view to its subsequent disposal, it shall classify the non-current asset or disposal as held for sale at the acquisition date only if all the other requirements have been met. So, yes, I need to mention this too. Measurements, yes. In fact, in any standard, you need to look at your definition, your scope, your measurements. Very, very important. So that and presentation, yes. How is it presented? Where are you going to have it? I hope you can see my screen because somebody is saying I'm just talking. I don't know.
We can see your screen, sir. I can see your screen.
So measurement of a non-current asset or disposal group. An entity shall measure a non-current asset or disposal group classified as held for sale at the lower of its carrying amount and fair value less cost to sell. I've mentioned this before under the objective, remember. Also, an entity shall measure a non-current asset or disposal group classified as held for distribution to owners at the lower of it, the same way too. So there's nothing different from what we have. If a newly acquired asset or so meets the criteria to be classified as held for sale, applying paragraph 15 will result in this asset or being measured on initial recognition at the lower of its carrying amount had it not be so classified. For example, costs and fair value less cost to sell. Yes, if the asset or disposal group is acquired as part of a business combination, it shall be measured as fair value less cost to sell. So when the sale is expected to occur beyond 1 year, the entity shall measure the cost to sell at their present value. Any increase in the present value of the cost to sell that arises from the passage of time shall be presented in profit or loss as a financing cost. So, yes, I need to take this part to recognition of impairment losses and reversals. Please, this we need to understand it because these are the areas they may want to really test your understanding. It's not straightforward like that. So, recognition of impairment losses and reversals. We have recognized impairment losses. Your impairment is captured under IAS 36. So, we'll get there, or I don't know whether I'm the one that will take you, but we will take you all the standard by God's grace. So, an entity shall recognize an impairment loss for any initial or subsequent write-down of the asset or disposal to fair value less cost to sell, to the extent that it has not been recognized in accordance with paragraph 19. An entity shall recognize the gain for any subsequent increase. You have what impairment is all about is that when you check your net book value and the fair value of that asset, you realize that your fair value is actually
Lower.
compared to the net book value. Then there is an impairment. That you are carrying that particular asset above the amount you can actually get it sold. That's the simple analogy about it. You are carrying it at an amount that is higher than the amount you can actually get a seller for it, or the amount you can recoverable amounts for it. So when that happens, you now need to write it down to the fair value amount. So the difference between that amount and your carrying amount is your impairment. I hope you understand. So
Yes, sir.
let's now see that. Let me cite an example of an asset. Let's say a car. The company, one of the company's car. It has been fair value to be sold for 50 million as at the end of 2024 December. So by the end of 2025 now, we now realize that, and that's the fair value amount of it. So we now have in the book, in the net book value of that particular center is now 16.5 million. That is a difference of 1.5 million. That's an impairment of 1.5 million. So that impairment will be captured under POF as an expense. Okay? So, and it's going to reduce the value of your assets, that particular motor vehicle, by that amount. To be charged against it to reduce it. Now, the next year now, which is 2025, we now realize that that same motor that we value at 15 million is now even being sold at 18 million. What happens? Yes, I even love the way I'm going with this example. So what you will do, you need to pay attention to what is the impairment amount before you now capture the increase in the value now. So you go and check what is the impairment amount. The impairment amount was 1.5 million, but the gain amount is 2 million. Then you are restricted to only recognize 1.5 million. I don't know whether somebody understands what I just said. Hello?
We can hear you. Hello,
Yes.
sir. Hi, sister. Well, please come again.
Yes, I can come again. So I said, let's assume I fair value my motor vehicle and the value I got is 15 million. Whereas in the book, the carrying amount, the net book value is 16.5 million. That clearly is an impairment of 1.5 million. That is 16.5, which is the carrying amount. And the fair value amount, which is 15 million. So the difference between the two is 1.5, which is because the carrying amount is higher than the fair value amount by that 1.5 million. Okay? I now said that happens in 2024 year end, or let me even be practical clearly. No, let me just focus. Let me say that the year end of that particular company is usually June 2020, June of every year, so June 2024. So by June of this year, we have done our impairment assessments, we have done our fair value, and we realize that that particular motor is now being to be sold for 80 million. And the net book value at this time has also reduced. The net book value before was 16.5. We reverted it to 15 million. The net book value has also reduced by, let's say, 1 million again. So, making it that there is a 3, is it 3 now? Well, that will be 14. There is a 4 million difference. There is a 4 million difference between what the fair value is and what the net book value is. This is a gain. This is a positive one. In this case, there is a 4 million. But remember, the last time, the impairment you have recorded is how much? 1.5 million. You cannot recognize more than 1.5 million as your gain. Okay? Because it's meant to net off the earlier loss you have when it's the earlier impairment you have. Cannot recognize more than that difference. Okay? So I don't know whether you understand. Let me know if you don't.
Hello, sir.
Not too clear.
Can you hear me, sir? So what
You said?
happens to the excess? What happens to the excess? You said we
It's not.
cannot offset more than the 1.5 that was
Yes.
earlier impaired in the previous year. So what
Yes.
happened to the excess?
So what will happen at that point is you will not recognize it in the P&L. That will be recognized under statement of comprehensive income.
Yeah.
Because you want to actually net it off, and what you are netting off must not be higher. You can't be recording and again. So you just irrespective of what the value is at that time, you just bring it back to the previous one. You will not even deal with the excess. You don't have anything to do with it. What you are going to, we'll see it practically. Don't worry. Time is running out, and I need us to understand this part. So you only recognize, he said, this is captured there. An entity shall recognize a gain for any subsequent increase in fair value, less cost to sell of an asset, but not in excess of the cumulative impairment loss that has been recognized either in accordance with this IFRS or previously in accordance with IAS 36 impairment of assets. An entity shall recognize a gain for any subsequent increase in fair value, less cost to sell of a disposal group. A to the extent that it has not been recognized in accordance with paragraph 19. B, not in excess of the cumulative impairment loss that has been recognized, either in accordance with this or previously in accordance with statistics on the non-current assets that are within the scope. Okay, so the impairment loss recognized for a disposal group shall reduce or increase the carrying amount of the non-current assets in the group that are within the scope of measurement, blah, 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 blah. So I think that will be all for me when it comes to treating this this particular. Okay. So we can read up.
Hello, sir.
Yes.
Hello, sir. This
Yes.
you mentioned some conditions for this non-current asset held for sale. So I want to know, must an asset meet all these conditions before it can be classified as non-current asset held for sale, or if it meets one out of all, it can still be classified? I don't know if you get the question,
all of
sir.
them. It must meet all of them.
Okay.
All of them.
All right. Okay.
Without exception. Let me see. Okay, let's open the question I sent to us.
Christopher, please mute your mic.
Okay.
It should be removed, Gary. It has been torn on our flesh.
Have we opened it?
Is it not okay like this?
Hello, have we opened the question?
Yes, yes.
Okay. So I need us to go through it together and see whether this standard is applicable.
Hello, Mr. Yusuf, please, can I say something?
Yes, go on.
Yes, when you are teaching us this impairment loss and gain and something, was it that you are typing it somewhere because your screen was not moving that time? It was just stagnant. So that it's not that we have missed something.
No, I was just trying to refer you to impairment. Like I'm just what I have on the screen is IFRS 5 and the content of IFRS 5 standard. So my
Okay, because
reference
I just want to be sure
just to explain to you that okay, this standard is affected by impairments and loss. So and as such, I was trying to explain what it's all about when we talk about impairments.
I just want to be sure because you are mentioning of fair value is 15 million, MPV is
I was just citing an example from nowhere. That example was coming from nowhere. It wasn't in
I just want to be
the
sure, maybe because your screen was not moving that time. I just want to be sure. Thank you.
It's not from the material. So let's go through the question together. Question 3, right?
Please, where is the question? Thank you.
Really? I drop it on all the groups, so check your group. I've dropped it before the class started. Are we together? Can we move on?
Yes, we can move on, sir. We are together.
Okay. So you are the financial controller of Gogon Group. On January 2, 2021, you are busy preparing the financial statement for the year ended December. You are under a lot of all of that. It's a story. Now, the first issue. Gogong Group has 3 investment properties in its books. Investment properties are measured in the financial statement at fair value, as permitted under IFRS 40 investment properties, while owner-occupied properties are measured at cost less accumulated depreciation and impairment losses. That's IFRS 16. The properties are currently presented at 2019 year-end valuations. No adjustment have been made for the current year. During the year 2020, there was a change of use of 2 of Gogong Group investment properties. Property A commercial warehouse located at Apapa, that has been let on a commercial basis for a number of years, was reassigned as office space for the company. The tenants were notified and vacated the premises on May 1, 2020. The property was valued at 8 million on January 1, 2020, 7.6 million on May 1, 2020, 7.4 on December 31, 2020. Who can just simply tell us what this is all about? Hello?
Reclassification of an investment property into owner occupiers. Just reclassification of investment property to now owners occupier.
Okay. And the movement of the value from 8 million to 7.6 to 7.4, what does it imply? What are they, what language are they speaking?
Revaluation.
Evaluation of the value. Evaluation.
Yeah, they are not using the right word.
Impairments. Impairments.
Thank you.
Impairments.
Thank you. The value was reducing. The value was reducing. That's impairments. So when they now said it was valued at 8 million, 7.6, 7.4, what could they have used instead of it was valued at? If they did not use that word.
Value.
Fair value. Thank you. I need you to be on the same page with me. It means we are passing, you are getting it. This is very crucial. They now said that it is a company policy to depreciate owner-occupied property at a rate of 2% per annum on a monthly basis. So this means that 2% is for a year, but it will be prorated based on the number of months that is involved. So just note that one. Now, property B was acquired in year 2014 for 10 million and is valued at 9 million on January 1, 2020. In late 2020, resulting from falling property prices in the country, the director agreed to dispose of this property. The property was empty since September and was put on the market in October with an asking price of 8.8 million. Although there has been some interest in the property, no firm offer has been made by the year end. Estimate of disposal costs are about 600,000. The value remained at 8.8 million at December 31, 2020. Property C is valued at 18.5 million at December 2018. The summarized financial statement of Gogong and the 2 other companies as presented. Okay. Now, the second issue. On January 1, 2020, Gogong commenced a defined benefit. I don't want us to go into that second issue. Now, discuss and carry out the analysis of the required accounting treatment of the first issue, showing relevant calculations and impacts where appropriate on the financial statement of Gogong PLC as at December 31, 2020. Let's go back. Now, for property A, how are we going to treat it? So I'm going to come up with an Excel to start off. and I'll be showing that to you.
The question is scary.
Okay, so let's even state what the issue is for each of the properties ABC. So let's begin by listing all the properties. This is A, B, C. The date of reporting is January 1, right? 2020. Are we together?
Yeah.
Hello?
Yeah.
So what has happened? What has happened to each of them? So from the question, what is the value of property as at 4th January 2020?
$8 million.
8 million.
Okay. Okay. Property fee, how much? As at 4th January 2020.
1.6.
You said?
Please.
Shared very well. But what the property B?
9 million.
9 million.
9 million. Thank you.
Okay.
C. Oh yeah.
80.5 million.
You said?
80.5 million.
18.5 million. Thank you. So, what happened to each of them? What did they say happened to property A?
It got devalued.
No. What was the action the company decided to take on property A?
It was reassigned in the office space. Classification. It was reassigned space. Office space. Office space. Owners occupier.
Owners occupied. B. It was B that was assigned as office space. So you go through the question very well. Yes or no?
No.
I think it was A.
It was A that was reassigned.
Okay, let me come back to the question myself.
Sorry, sir. The property C was valued at December 2018. How come we are listing it on that 1st of January 2020?
As at that date till now, no other information about it. So information has not changed about it. So we take the last information we have. Remember, I mentioned this night that when it comes to fair value, you deal with information. You can't manufacture it from nowhere. So the information we have last about it is that figure. irrespective of that, the fact that the time has been long, there's no other updated one that we can deal with. So you understand?
Yes, yes, thank you.
Okay.
Sir, what about the 7.6 million and 7.4 million?
Hold on now. Check the dates now. Check the dates of those ones. Is it the date we
Yeah,
are
the date
dealing with?
is May 1st, 2020
The-
for
wait now. The date we picked this value for, this 8 million, what date is it?
January 1, 2020.
And the date we are dealing with is January 1 now. So relax on those ones. Don't worry.
Okay.
Yes, this particular property B is a very good one for us to see whether we understand what we just discussed. While the third one, nothing happened, no other information. So we just adjust it to their value. Yes, this is we are setting the space. No, property C, I think you gave me, okay, I'm coming. I need us to confirm something, please. The property A as at January 1.
Is 8 million.
But it was disposed of this.
You said?
So that means that property A is not qualified to be asset held for sale because it was changed to owner occupied.
Yes. It's and that's it. Level. Sorry, I did not even know I muted myself. Okay, so what's the total value of investment property in the question? In the financial statement presented, that draft, they just showcase some items. Hmm?
120 million.
No,
120.
check it very well. Check it very well.
32,000.
32,000.
32 million.
32 million.
Yeah.
So if the total is 32, and we know the value for the A, and we know the value for B, what will now be the value for C? Can you see what I just did? Hope you can still see my Excel.
Yes, sir.
Yes, sir. Did you see what I did now?
Yes, sir.
Mm-hmm. So this should be the value of C.
Sorry, sir. Please explain it again. I did not get how you got the value for C.
Yeah, check the question says that the total value of investment property, and we are dealing with investment property here. Total value of investment property in the draft financial position is 32 million, right? Can you see that under Gogon PSC?
I can see it, sir. Yes,
okay,
sir.
So that 32 million is the total of all the investment property, and we have confirmed the value for property A and property B to be 8 and 9 million, right? Yes or
sir.
no?
Yes, sir.
So what we just did is to take the 2 out of the 32 million to get the value for C.
That'll be 15 million.
Mm-hmm.
All right, sir.
Hope we are on the same page now.
But
yes,
you
sir.
You wrote 18.5 million.
Before now.
Okay. I'm changing it now.
I just discovered that that's not the way it should go.
Sir, please, just one more recap on the 15 million, please. I beg you.
Okay, so from the statements, the financial position statement given to us from the question, can you locate where we have 32 million under Gogon PSC?
Yes, please.
So that's the total value for investment properties. And this investment property comprises property A, B, and C. Yes or no?
Yes.
So if that is the case, then we know the value for property A, which is 8 million. We know the one for property B, which is 9 million. Then the difference is what we have for property C. Let me put the cursor on that. You get it now. You get it?
Yes, please. Thank you.
All right. So we can move on from here. We need to be fast. So by 11, I need to go because if I go to my room, there will not be network again.
But sir, I feel the 32 million we are picking from the draft statement is as at the December. Yeah, and we are trying to recognize this when we are trying to analyze there as at January 2020.
Yes, you are right.
And we are given the fair value of this same property C in our information to be 18.5 million.
That is as at 2018. Remember?
Okay.
So, so the information available for it that we align with those January 1, 2020 is why we are picking the 32 million, because the others, if we can check, the others have their changes over the year, through the year. There was a difference as at the end of the year for property A, but property B2, I don't see it changing, except that they said the amount they want to use to dispose it. So it also remains the same. So we can infer from there that property A is the only one that actually experience change from that date. The same amount that we have for property B is the same amount we are closing with, because except they just pointed out that, oh, that we need to calculate. Okay. The value has reduced to 8.8 million as at October, because that's the very value they got in October, and that's the value. So there was a movement of prices over the period for the two other properties, but this one, no other information. We just said it's valued as this as at 2018. So the balance figure is what we have to use for it. Others, they provided their own figure. You understand? As at that date. Do you get it? We move. So the next thing we want to do now is you now need to take them one by one. Okay? Can anyone hear me? Because nobody's answering now.
We can hear you, sir.
I hear you.
So let's now deal with each of the property one by one. From the information we have so far, can anybody tell me, does property A fall within the ambience of measurement of IFRS 5 or not? That's what I need to establish.
No. No, sir.
No.
It does not, sir.
Why?
Because there was a change to ownership. What I mean by change of this owner occupied is not in line with IFRS 5, asset held for sale. This change of ownership now have disqualified that particular property from being classified as assets held for sale. Then B.
No, don't go to B. Don't go to B yet, please. Let's deal with A first and be done with A. We have a lot to do with that here, so let's now pick them one by one. You are right, but not tally. There is another reason why it's not qualified for. I will not say it now until we are done with everything. So we need to now start measuring it with the dates now. So we need to look at the dates impact. So the first date, fair value at January 1, 2020 is what?
8 million. 8 million.
8 million. Which other dates do we have fair value for it?
May 1st, 2020.
What's the amount?
7.4 million.
7.4.
7.6.
7.6.
What's the difference?
400,000.
400,000.
So that's your impairment too. Okay. That's your impairment. So you call it impairment or fair value adjustments. So do you understand what I just did here? So that we can move on. I need to also finish this question before.
Yes, sir.
Okay. So we still continue that's not the only thing we do to it, because we need to see what happens to the net book value. So depreciation is to be charged on it, since it has now become. You remember that the reason why we found this particular approach is because, I don't know, we have not done IS 40 actually, but under IS 40, you are not allowed to use depreciation. You are only allowed to use valuation. So evaluation rather. So under evaluation, you value that building, that investment property. So for that reason, that's why we did this. And as at the time it has now been converted to owner occupied, then it returns to IS 16, which is PPE. So from that May 1, the value we have is 7.6 million, right? So you now calculate depreciation from May 1. When is the end of the year?
31st December.
According to them. So May 1 to December 31st. How many months is that?
8 months.
Good. So 8 months. So we now have to calculate 7,600 multiplied by 8/12. What's the percentage of depreciation given to us?
2%.
2%.
You get it now. You see the figure. This is our depreciation value. So the carrying amount as at the end of the year is now how much? Who can guide us on how to go about it?
76 minus 10133.
You got it. You got it. So minus what we have here. So these are carrying amount for property. So we now want to know whether there is impairment or not. We test based on this now. So this is our carrying amount 7.98, but our fair value figure is
7.4 million.
No.
December 2020.
Okay, as at that date, yes. Yes, at the end of December, yes. Fair value at December, yes. All right.
Okay, sir.
So that's the amount is 7.4 million. So which one is higher? That's the way for you to. That's how you know whether there is impairment or not. Which one is higher?
Carrying amount.
You said?
Carrying
amount.
So if carrying amount is higher, is there impairment or not?
There is impairment.
There is impairment.
It's as simple as that too. You have learned the impairment straight away with that. Only that if it is impairment question, they will give you recoverable amounts. You need to do your discounting factor too. to establish how much so this our impairment for the year. Okay, we are done with property A like that. Oh yeah, read the information on property B and tell me whether IFRS 5 applies or not. Let's be fast. I need to leave now. Anytime from now, you come and chase me out. Hello, is anybody there?
Yeah, we are with you.
Oh yeah, read the question or read the information on property B. Property B was acquired in year 2014 for 10 million and its value is at 9 million on January 1, 2020. In late 2020, resulting from falling property prices in the country, the director agreed to dispose of this property. Property was empty since September and was put on the market in October with an asking price of 8.8. Although there has been some interest in the property, no firm offer had been made by the year end. Estimate of the total cost are about 600,000. The value remained at 8.8 million. Blah blah blah. Now, does this have to be dealt with using IFRS 5 or not?
Yes, sir.
Okay, we can use IFRS.
Yes, reason being that the management have declared interest to dispose such assets and depreciation has not been charged again.
Okay. Any other opinion? Do we agree with him?
Yes, but they were not able to sell it within a year.
Okay.
So which means that it's continuing to be
You said?
because they were unable to sell it for that year, so they continue to present it as investment property.
Provided the management is still interested in disposing it. There are
Okay.
some factors beyond their control.
I love this particular scenario. So it means that I don't know whether somebody is listening. You are not listening. So sorry to say that to you guys. I told you there are exceptions to the rule of IFRS 5, and this, in fact, I love this scenario depicted here. This is one of the exceptions. Let me show you we project my slide again and take you to where all of this. There are exemptions, there are 6 of them, and I was hammering on it when I was saying it. I'm not sure somebody was listening. Okay. So let me represent this particular part. Oh yeah. When it comes up, you see. Has nobody seen? The measurement provisions of this IFRS do not apply to the following assets, which are covered by IFRS instead, either as individual asset or as part of a disposal group. Oh yeah, you can see IAS 12 there. You can see 19. You can see 9. You can see 40. And we are dealing with 40. You are now saying that you see classified that under IFRS 5. Why now? Why? It was clearly stated that this is still under IFRS 40 because they said the property was empty since September, whatever. There has been some interest. That's not. They never said it has fallen out of. In fact, we even checked the statement of financial position and we checked that the total investment property there is 32 million. So it's still under IFRS 40. For that reason, you can't even consider it for IFRS 5 at all. These are the little things you need to pay attention to. Do we understand now?
Yes. So which means that it still remain investment property until
Yes,
the grade is
yes. The second thing is that you now said that since the some people said yes, since the company decide that they are still willing to sell at the end of the year. For that reason, they are still, some say they cannot still be classified again. Insofar they have the intention and they made efforts, they made move. When they are not able to sell it, it does not take it out of IFRS 5, although this one is not IFRS 5 related. But if it's actually qualified for IFRS 5, then that condition is not valid. That they do not sell it does not mean that they have not made effort. It's the effort that is important. Okay?
But I thought you said that those 5 conditions must be considered as a whole. Somebody asked that question, that must those assets be must they fulfill those conditions? And he said yes. Yeah, I felt that even if an asset is put forward as head to sales and the management has made frantic effort to actually place to sell it, and if that sales must be probable under a year, must be probable under a year. That's what I know as my
They never said it must be certain. So in fact, I love that you are the one that even bring it up that way. They never said it must be certain. They said it must be probable. It's still a probability. Okay? So if they have said that it must be certain that they must be able to sell it, we will consider the fact that yes, once they do not sell it, it's not no more to be classified as IFRS 5. But if they said it must be probable, that there should be probability of getting it sold. Probability is never one, no. It's usually less than one.
What is the time limit for that probability? What's the time limit?
I was explaining that. I said it that time that even if the sale do not happen in that year, insofar they have made the necessary efforts, you have seen commitment on their part. I explained it. I don't know whether anybody listened that time when I was explaining it. I don't know, but I'm very sure I mentioned it, and I actually took time when I was explaining that part because I knew very well much that it will create great confusion. So, insofar they have made efforts to sell, if they did not sell, it will still continue to be classified as S for sale in the following year. I hope that clarifies it.
Okay, noted.
So, for that reason, property B is not to be treated as IFRS 4 and IFRS 5. Rather, we will only recognize the fair value change or the fair value updates on it. It was 9 million before, it's now 8.8 million. That's the fair value issue as at October. So, and that's the figure they will carry to the end of the year. So there is an impairment of 200 million. But that does not end there anyway. That does not end there. So once you recognize that 200 million, 200, is it 200 million? It's 200,000. So that 200,000 will be debited into profit or loss and credited into investment property. Remember, for an asset, if it increases, you debit, right? Are we on the same page on that?
Yes.
So
no, we are not on the same page there. Sorry.
I said the fair value on 1 January is 9 million, as we have identified before. As at the end of December, it is 8.8. It was stated in the question that it's now 8.8 as at October, and we did not see any other figure being quoted till December. So we will take that October figure as the last fair value figure for the year. Okay?
Okay.
So we now compare that 9 million with 8.8. We have a difference of 200,000. Okay, that's fair value adjustment. Do you get that too?
Yeah, it's just like the calculation we did earlier for the former for property.
Yeah, we can simply just do that one now too. But I'm just wary of time because you soon
Yes,
hate
yes.
me there.
All right.
Property B. So fair value at 1 January 2020 is how much?
Can I
That's
see your
9
Excel
million.
sheet?
Oh,
We
sorry,
can't see your Excel sheet.
sorry. I've not changed to Excel again. You see it now. So, let me write everything in full. Okay, so fair value at 31st December is 8.8 million, right? So fair value adjustment is how much? The difference between these two. You get it? Hello? Are we together?
Yes, sir.
Yes,
So
sir.
you then now need to post this fair value. For property A, if common. Property A, our fair value is what? 400,000. No, there's no way I want to put this there. So you debit profit or loss for property A with 400,000. You now credit property A with what? 400,000. This concludes this part. For property B now, you debit your profit or loss. Yes, with 200. You now credit property B with 200 as well. This concludes the posting here for this as well. So for property C now, so fair value at December 2018, how much? 18.5, right? Fair value at December 2020.
Sir, we impaired them property twice.
So why are we considering just one impairment cost?
You said?
I said we impaired property A twice. Like the impairment was done twice, but we only considered one figure.
I'm coming. Okay. Oh, we're supposed to still go on and repair it to 7.4 at the end of the year.
Yes, sir.
No, don't worry your head, Gary. Remember, check this place. The carrying amount at the end of the year, we had how much? 7.498, which was for what we have as at that 7.6 minus the depreciation that we have from that period. Then the fair value at December, and we have used it now. Check that 7.4 that we have paid. We have already used it.
Yes, yes.
We have used it.
Yes.
So we don't need to be bothered about that. So this at January 1, yeah, is what we calculated the other time, which is 32 million minus 9 million minus 8 million. This 9 million is not complete. So what they are now telling us is that as at December now, that our 18.5 is what we are now going to use. You know why? As at 4th January, how we arrive at 15 is the fact that we know the figure for property AP, and as at December of the end of the year, we now have a figure that captures all of them. But out of this figure, property C was not shown to have changed or increased or decreased whatsoever. So there will be a statement that will corroborate this. Let me check. I want to believe this 2018 figure they are quoting is not right. It's meant to be December 2020. So that's the only explanation I have for this. It's not because if I want to check out what the figure will be at the end of December, you know, the one I used before, I actually clearly stated that is what is accounted for as at the beginning of the year. So there is an improvement to the property this time around, unlike impairments. So this fair value adjustments. I just need you to see how this is will be posted now. So you debit this time around, you are going to debit property C with the difference. and you credit profit or loss. The meaning of credit profit or loss is that there is an income. So let's get that rightly. So I've overspent my time here. They have already told me to get out. So
where do you see the 15 million for property C?
That was the difference between the 9 million, 8 million from 32 is the balancing figure that we have.
From where?
From the financial statement. I'm coming. Hold on.
Okay, the financial statement.
Yes.
The total figure for financial statement is 32 million. So we remove the first two property. The balancing figure for C is that amount.
I don't know. I don't get it though.
If you look at the draft financial position, we have under the investment property, we have 32 million. So that is invariably the total amount of the total amount for the three investment property that we have. Property B. So the balance figure is for property C because that was not actually given in the information we are first provided with.
Okay.
So guys, I'm sorry I need to leave now. I've been delaying them from closing the mosque.
So that 32 million we have to minus those from
how did they have
property A, property B from it?
Yes, please, how do you have 101,333.33?
That's the depreciation charge for 8 months. That's 2% of the.
Please help us send the solution to the group chat so that we can check it out. Thank you.
Yeah.
So no problem. I'm already sharing it.
And with the materials, sir.
I'll share it. Oh.
Thank you.
Thank you. Materials too. Oh. Okay. So, because of time, we have to close now. Thank you for coming.
Thank you very much.
You're welcome.
Thank you.